Due to recent changes in the value of cryptocurrencies, many investors don't know what the future holds. Existing investors might worry about losing money if the cryptocurrency bubble bursts, and people who want to invest might not know when is the best time to do so. Everyone who invests in cryptocurrency should think about how the market is doing, how bubbles form, and how to spot these patterns. What is a crypto bubble? A market bubble happens when an asset is worth more than its market price. Investments and other assets are usually valued based on demand, profitability, growth potential, and other factors. But sometimes the value of an asset goes up more than expected. A cryptocurrency bubble is caused by the following things. When people are excited about an asset, its price goes up quickly. When investors buy an asset because they see its value going up, the price goes up even more. As more people buy the asset, its price will rise above what it is worth. A cryptocurrency bubble doesn't always happen when prices go up quickly. For example, prices might go up when the economy is getting better after a recession. The main difference is that these price increases can be explained using the same criteria that are used to judge investments. Getting more money. Is there a bubble in the crypto market? It's hard to tell if the value of different cryptocurrencies is fair or if it's just a result of excitement making people pay more than they should. Unlike cryptocurrencies, which are most valued based on factors like demand, manufacturing costs, and competition, traditional investments are valued based on business performance and other financial parameters. Bitcoin, one of the best-known cryptocurrencies, is said to have had many bubbles over the years. In December 2017, before it blew up, its price had risen to almost $13,000. In 2019, it went from being worth about $3,400 to be worth over $12,000. Bitcoin finally went over $61,000 in October 2021, after going up and down many times. Even though Bitcoin's price has dropped to $21,450.54 as of August 23, 2022, this is still a lot more than many people who were skeptical about cryptocurrencies thought it would be worth when they first came out. Because the value of Bitcoin is mostly based on speculation, it is hard to say what caused these changes. How Bitcoin bubbles work. In most markets, bubbles form and pop in the same way. Before a bubble bursts, investors' views on a certain investment or investment vehicle often change because of something. In this case, the rise of cryptocurrencies may have led to some interesting new ways to invest. Then, the investors will start to learn about the possible benefits of the investment. Speculators will start to take risks, which will drive up the price and attract more investors. As an example, Bitcoin's rise from 2017 to 2019 shows that this phase is happening. At its peak, the bubble will bring in a lot of new investors who believe there is little risk and a lot to gain. They might invest in things that don't make sense, which would make the price go up even more. Lastly, some investors could lose money, which would make other investors want to sell their shares. This has a snowball effect. Some investors may exit with profits, but those who wait too long to sell may incur substantial losses, and the value of their investments may decline once more. Getting more money. Even though Bitcoin's price dropped a lot after it reached its peak in 2021, it's hard to say if this is a true crypto bubble because it's hard to say what criteria are used to value cryptocurrencies. Where to look for a bubble. The best sign of a crypto bubble is the market behavior we just talked about. Still, many investors won't notice a bubble until it pops. Also, it is harder to spot crypto bubbles than it is to spot bubbles in traditional markets. An investor may be able to predict a bubble if the price of a traditional investment starts to rise faster than its real value. People can figure out how much investment is worth by looking at how well their businesses do, their finances, and other factors. But these traditional things can't be used with cryptocurrencies. A trader might be able to spot crypto bubbles by looking at how investors think. For example, if the price goes up quickly right after a popular post on social media, it could mean that investors are interested in a new chance. The future of cryptocurrency. By 2030, the market for cryptocurrencies is expected to grow by almost 3 times what it is now. Even though more businesses, organizations, and people are starting to accept cryptocurrencies, there is still a lot of doubt about how valuable they are and how to make rules that make sense. Getting more money. Investors in cryptocurrencies point to benefits like easy payment management, accessibility, and working more closely with other people instead of banks and big companies. They are worried, though, about how volatile the market is and how to protect their assets. There are different ideas about how the government should regulate the cryptocurrency industry and how big companies should invest in it. Many investors are worried about cryptocurrencies becoming more corporate because they like how they don't follow the usual rules. In the future, governments, businesses, and people will need to work together to create a system that strikes a balance between the need for regulation and the need to keep cryptocurrencies peer-to-peer. It is hard to say if a crypto bubble is starting to form right now. Because of this, people who might want to invest in cryptocurrencies might not be sure if they want to. When deciding what to do with money, people should think about why they want to invest it. For example, if someone buys cryptocurrencies just because everyone else is doing it, they might want to think about it more before buying. If you enjoyed this video, don't forget to subscribe to our channel.